The Taxpert Pencon tool is a very sophisticated, but I hope easy to use way of determining the tax consequences of a taxpayer's pension contributions, both direct contributions and defined benefit contributions, typically from an employer. And I'll give you a quick run through of the basic entries. It is very complicated. Pension contribution tax rules have changed significantly over the years, but I hope that this tool will help agents and advisors to give their clients the best advice when it comes to the tax consequences of various contribution strategies. We start by looking at the input screen where there are three columns: the current tax year 24/5. Let me just input a figure there of 275,000 of income for the current year, and I'll go back to the screen. The earlier years of 22/3, 23/4 can also be input. Earnings, other income, reliefs, I haven't put in any there. You have to specify that you're a member of a registered pension scheme. Otherwise, if you're not a member, so if you're just starting pension contributions this year, your allowance for years in which you were not a member will in fact be nil. So if I go down for 22/3, in fact, you get no annual allowance in that line if I've toggled from yes to no. But we'll assume that you have been a member for several years and entitled to the normal annual allowance. And we then look at the various contributions. There may be salary sacrifice. Over here on the right, by the way, I've got some commentary as to what should be being put in the various boxes. So we'll have some direct contribution figures, 40,000 in the first year, 60,000, then 70,000, a link to where those would go in the SA 100 self-assessment tax return. There might be some old retirement annuity contributions paid gross. And then there may be some defined benefit and money purchase, net pay contributions and employer contributions. We're not going to go through all of this in a short video demonstration like this, but the app will then calculate the total pension input amounts, the key figure for determining the tax consequences. And we've then got the threshold and adjusted income figures, because of course, if your income goes above those thresholds, the annual allowance may be reduced. And we can see here on these figures that the annual allowance, which went up from 40 to 60,000 in 23/4, wasn't tapered in those 2 years because of the level of income, but in the current 24/5 year, the taxpayer would only be entitled to 48,750. What we then do is, there's also the MPAA, the money purchase annual allowance restriction if there's been previous drawdown, but I've toggled no for each of those, so that doesn't take effect here. And so the annual allowance for defined benefit and defined contribution schemes is 40/60 and 48,750. And then I can input the brought forward unused figures for the 3 earlier years, and going back to 1920, and then down here we've got an analysis of how those figures might be used. And in fact, I'm not going to enter those, it just complicates matters for this demonstration. But I then see that there would be, for the current year, an annual allowance excess charge of 21,250, and that's because the 48,750 is exceeded by the defined contribution gross figure of 70,000. So let me just put in, let's say I've got some brought forward unused of 12,000 from 2021. Does that help? Well, no, because that drops off in 23/4. But if I had some unused from 21/23 of, let's say, 15,000, then that I think would be used, and that reduces the excess charge to 6,250. And then we've got an analysis of how it's all allocated, all horribly complicated. I've also programmed it to show the minimum additional premium you need to make to use up any brought forward that's about to expire, and the minimum additional premium to retain your full personal allowance. Now, that's the input screen, but what will then be very useful is to look at the client report for presentation to the client. and I'll just zoom in a little bit on that. But the analysis here would be to set out the earnings, other income, the contributions, the available allowance, that was with that brought forward figure, the annual allowance excess charge, and then the consequence in tax terms, the 2813 is the estimate of tax on that annual allowance excess charge. And we've also got there the overall effective rate of relief on the defined contributions. And we do this for both the current year and the previous tax year, 23-24. And we've then got the workings, the tax calculations, which I won't go into in detail, save to say that this year I've enhanced the app by including the ever more complicated Scottish tax rates. And on the input screen, you can toggle between Scottish and rest of the UK. And that will then give us the different, slightly different figures here for the estimated tax charge and the overall effective tax rate, because of course, Scottish tax rates on non-savings income, and here we're looking at significant non-savings income, will be higher. So you've got the tax calculations, but then if we've still got the energy to look at it, I've got the scheme pays tool, and this would be useful where there is an excess amount. In this case, we've got the 2938, and it's through an employer scheme where the employer could then be asked to, or the employer's pension fund could be asked to make that payment. So that sets out the amounts that could be paid under the scheme pays provisions. And finally, there's also a tool for estimating the pension input amount for a defined benefit scheme, a horribly complicated calculation, which I've tried to accommodate on this screen. And what this does is take the employee contribution rates, pensionable earnings, etc., and on the basis of that, work out what the pension input amount would be for the employer scheme. So a very comprehensive and in many respects very complicated analysis, but it is an area that would benefit from advice that looks at all the different tax angles, and that's what I've attempted to do with this Taxpert Pencon tool.